Good morning and welcome to the Global View on this Monday. I'm Andrew Gagan. Thanks for joining us here at AusBiz. Let's take a look at what's happened over the weekend. More intense American and Israeli airstrikes on Iran, while Iran has continued to retaliate, targeting Gulf states. Global equity markets finished deeply in the red on Friday, with the rising price of oil sparking a sell-off in risk assets. Now, in the US, unexpected job losses last month increased hopes that the Fed will cut interest rates, but they appear to only add to investor concerns. The Dow posting its steepest weekly loss since April last year. The S&P 500 had its worst week since October. The NASDAQ also falling heavily, and the volatility index jumping to its highest close in 4 years. Well, the S&P 500 Banks Index fell 2%. BlackRock came under further selling pressure on its decision to limit withdrawals from a major private credit fund, and lender Western Alliance falling after suing Jefferies for not making a payment for loans tied to bankrupt auto parts supplier First Brands Group. Travel stocks sagged as those fuel costs jumped, and shares in chip company Marvel surged after forecasting fiscal 2028 revenue above estimates, and GoPro tumbled amid fall of camera sales. Well, energy infrastructure has now been targeted in the Middle East war, with Israel striking oil storage facilities in the Iranian capital, while Iran has struck a desalination plant in Bahrain. And President Trump said he's considering deploying special forces on the ground in Iran to seize its uranium. Meanwhile, Israel has expanded its military campaign in Lebanon, which has reportedly killed at least 400 people. And Iran has named Mohammad Khamenei to succeed his father Ali Khamenei as supreme leader, signalling that hardliners remain firmly in charge in Tehran. The 56-year-old is a mid-ranking cleric with influence inside Iran's security forces, who has long opposed reformist groups advocating engagement with the West. Well, in the US, labour market conditions have deteriorated, with the unemployment rate increasing to 4.4% last month, while non-farm payrolls unexpectedly decreased by 92,000 jobs. And the data presents a dilemma for the Fed, with member Austin Goolsbee saying the jobs report was a tough miss, but called recent inflation data disturbingly high. As we get more uncertainties, I think the time at which it makes sense to act keeps getting pushed back. Well, global government bond markets have registered one of their worst weekly losses in months on concerns that the war in the Middle East will renew upward pressure on inflation and force more hawkish policy from central banks. The US 2-year Treasury yield closing at 3.56%, the 10-year at 4.14%, the Aussie 3-year government bond yield at 4.45%, the 10-year at 4.89%. And the US dollar index that closed down slightly on Friday. The Aussie is trading at 69.8 US cents. Well, US crude futures surged on Friday as disruptions to global oil supplies intensified because of the expanding US-Israeli war with Iran. Qatar's energy minister has said he expects all Gulf energy producers to shut down exports within weeks, which he said could push oil to $150 a barrel. Brent crude futures currently settling at around $93 a barrel, Brent climbing 27% since the beginning of the conflict, the biggest weekly gain since the COVID pandemic of 2020. Gold edged up on safe haven demand as those Middle East tensions escalated. Spot gold at around $5,170 an ounce. Copper little changed. Iron ore up slightly, 104 US a tonne, and Bitcoin has fallen back to 66,000 US dollars. Let's get across what's going on globally then and begin with what we're seeing in New Zealand. Greg Smith joining us from Generate KiwiSaver. Greg, welcome to a brand new trading week. Of course, global markets very unsettled by what's transpiring in the Middle East, not the least, of course, the price of oil. How have you opened there?
Yeah, we've opened, and morning, Andrew, we opened a bit lower, but perhaps sort of bucking the trend a little bit, or holding a bit better than some other markets. CNZ 50 is down 0.89% at the moment, so yeah, a bit of weakness across the board. Fish and Paykel's down around about 1.3%. So the dual listed banks, as a bit of a heads up to yourselves, are lower as well. But yeah, we've held it relatively well, I suppose. If you look at the NZ50 over the last week, it was down around 1.5%. And I think, that's what's really interesting, is the divergent performance of some markets. So Europe down around sort of 7%. Emerging markets, likewise. UK, then you look at the US, S&P 500 was down just 2%. And most of that weakness actually came on Friday in response to the job numbers you mentioned. So obviously, which were a big miss. Yeah, looks like the Fed, certainly has a case to obviously cut, and perhaps as soon as July. But it seems like the market, particularly the US, is still signaling that this conflict is going to be relatively short in duration, and is it going to be prolonged? But yeah, I suppose oil is a bit of a key here and a bit of a site here. I mean, that's the huge sort of bottleneck, isn't it? And I'm just looking at it now. The crude price has jumped to $108 a barrel, so it's up around about 19% since that market's open today. So that was after a 35% gain last week. So yeah, that's the issue. Tricky situation for the Fed, of course, isn't it? So that oil price potentially will stoke inflation.
Well, in fact, you would say for central banks globally, in fact, because what is the prospect of the spectre of stagflation becoming very real now, Greg, given obviously the drag on growth that we're seeing at the moment, and obviously what oil is doing in terms of its inflationary effect?
Yeah, for sure. I mean, that word sort of will crop up more and more. In comparisons, will be with I suppose, the '70s oil crisis. I don't think we're in a crisis just yet. There's a few things that are a bit different this time around. Inflation, sort of heading into that crisis, was around about 6%. Worth remembering, the US was a big importer of oil. Now it's actually a net exporter. We're a little bit less reliant, particularly on gas. If you look at European gas prices, I think they're still around about a third, probably two-thirds lower than they were after Ukraine. So we're not there yet, but yeah, certainly big geopolitical risk premium gone into oil. And the longer that strait remains blocked, that's going to increase pressures on everything that's sort of connected with oil, I guess, not just oil and petrol, but freight, airfares. You've seen the big moves in the airlines. So yeah, I suppose there'll be more than a few sort of hoping that this we get some resolution. I'm not sure there's a clear line of sight on that yet. Obviously, the insurance issue was one that maritime insurers cancelled that. Trump stepped in with the 20 billion reinsurance program. Then he's offered also that, if necessary, to use the US Navy to escort these tankers. So having a look at it, the US Navy's got over 400 ships, but if you strip out all the ones that are in port or in training, there's actually only around about sort of 50 or so available, and there's only probably around about 20 in the region. So yeah, it doesn't look like we're going to get an immediate sort of end to this blockage at all with I suppose the conflict's still going on. So, but yeah, time will tell. And if we get some sort of, I guess Donald Trump is going to be watching this all unfold, particularly with I suppose, the market reaction as well. So, yeah, do we get any sort of coming to the table? I guess it's hard with that hard liner sort of taking over, as you just mentioned.
Yeah, it's going to be interesting, particularly how central banks do navigate this, and we do see those bond yields continue to climb at the same time, Greg. So, as an investor, where do you think you want to be? I mean, particularly when you talk about safe havens.
Well, we're KiwiSaver investors. We're actually long-term investors, so we are coming. And I think it's a little bit different depending on your time horizon. If you've got a 1 month horizon, I think it's very different to if you're a long-term investor. Warren Buffett, he's one of the most renowned value investors and long-term investors, said that geopolitical events are expensive distractions. That's sort of how we're looking at it. We're actually using the opportunity of this crisis. Not that you want to make, I'm supposed to be too sort of proud of that, but you really just use it as opportunity to pick up high quality stocks if you're taking a long-term view. And some of these stocks are being re-rated. Actually, and one we bought recently was Microsoft. Actually had a really strong week. It was up around about 4%. Some of those software companies have sort of come roaring back a little bit as well. So I think it's worth remembering, if you're a long-term investor, that stuff happens. And if you look at all the crises over the last sort of 100 years plus, the market does climb a wall of worry. And these sorts of crises, which are regular, do provide an opportunity potentially. So that's how we're looking at it. We're certainly not panicking or making decisions to go into cash or anything like that. I think it's should be treated as an opportunity potentially.
And Greg, domestically there in New Zealand, obviously you've got a big ag sector. Interesting, of course, this is going to have impacts there for ag because certainly fuel costs, also fertiliser as well. I mean, a lot of that moves through the Middle East there. What are you seeing in your ag sector at the moment?
Yeah, well, actually, we've had a bit of good news. When you talk about pricing, the dairy auctions were pretty weak throughout last year. So, the first few auctions this year have been, been quite strong, very positive affair. So you got the global dairy index actually up over 25% year to date. So, that's good for our, there will be costs sort of coming through, as you say. Transport and the like, and feed costs and so on. But yeah, the dairy sector's had a good start to the year at the top line. And also this is reflective in Fonterra as well. They've upgraded their forecast milk range. And also today, quite a bit of important news as well there, Andrew. They've said that the $4.2 billion sale of the mainland or the consumer goods group to Lactalis is unconditional. So that's going to see several billion trickle through to our economy, you would think, over the course of, say, the second half of the year. Farmers have said they're using it, to anecdotally pay down debt, but there will be certainly some expenditure rolling through the economy, and that will be very welcome in terms of the timing.
Greg, great to get across all those movements, particularly globally. Thanks for joining us from Generate KiwiSaver.
My pleasure. Bye for now.
All right, so let's come back home then. Ahead of the open here, we are expecting a significant leg lower when we get going. If we take a look at the S&P ASX 200, their futures down close to 1%. We are very much focused on what's going on with oil there. Greg just talking about having moved well above $100 now. That's where a barrel, I should say. So that is incredibly dynamic at the moment. We'll continue to monitor that across the course of the day. Stay with us.